We've all seen the headlines of corruption scandals in voluntary carbon markets, or VCMs. From carbon cowboys seizing land and claiming they have the right to generate credits, to phantom projects producing credits for schemes that only exist on paper. These exposés are vital in holding market participants accountable and deterring malpractice. But negative coverage has stoked public scepticism, deterred buyers, and caused carbon credit prices to tumble, putting the future of a market that puts the net in net zero at risk. If done right, VCMs could still be vehicles for reducing greenhouse gas emissions. By channeling climate finance to the places that need it most, they can offer sustainable alternatives to polluting livelihoods. In rural Brazil, for example, employment opportunities are limited, and often the only viable option is to cut down trees for cattle grazing, destroying the forest's role as a carbon sink and releasing methane. VCMs create an alternative option, generating income by preserving the forest instead of cutting it down. If done badly, carbon credits become, at best, little more than greenwashing, and at worst, could worsen environmental damage and the marginalisation of vulnerable communities. To scale VCMs with integrity, we must first understand the nature of corruption risk, address its enablers, and restore confidence. However, despite the bad press, no comprehensive study has yet mapped the full spectrum of corruption risks in VCMs. Our new research, the first in a free report series, begins to fill this gap. We found that certain features make voluntary carbon markets susceptible to corruption, namely weak due diligence exacerbated by potential conflicts of interest, ambiguity over which stakeholders are responsible for conducting these checks and owning the risk, and transparency challenges regarding the ownership and transfer of carbon credits. These problems are intensified by volatile market cycles. Booms draw in opportunistic investors, and busts reduce funds available for thorough due diligence checks. We also found that VCMs are ill-equipped to manage these risks in fragile governance settings where corruption is already rife. Ultimately, however, the paper left us with more questions than answers. There was no consensus among market participants about the extent of corruption in VCMs. In fact, some experts we interviewed argued that in high-risk environments, VCMs have more protections than other commodities like minerals and timber, arguing that credit registries provide more transparency than other commodities. Others reported having experienced corruption firsthand, particularly in the 2000s. But we found no systematic evidence that would let us definitively say whether VCMs are more or less vulnerable to corruption than other markets. Our next two reports will go further, gathering evidence on corruption prevalence and perception in the market, and conducting in-depth case studies to understand how corruption occurs in practice. Our ultimate aim is for our research to inform solutions that will help to improve confidence in the voluntary carbon market and allow it to deliver real climate impact.